Hello and welcome to Bloomberg Quint. I'm here with Mr. Sunil Subramaniam, the CEO of Sundaram Mutual, who is here with us to make sense of what's happening in the markets currently, whether or not we have some opportunities out there, and also what we can expect from what is looking like a very volatile January and a start to the new year. So, Mr. Subramaniam, thank you for joining us. And I'm going to ask, start off by asking you, we are expecting some downgrades with respect to earnings for the third quarter, and of course some weakness in the fourth quarter. What is your take and how are you looking at earnings there?
We think that the demonetization would definitely have had a severe impact on the consumption-oriented sectors, especially those which have a cash-based. So the bottom of the economy, those like FMCG, your base level of consumption, definitely is going to get impacted. It's not just impacted because of the lack of cash, as the cash is going into the banks, but it's also impacted because of sentiment, because people are now hesitating to spend, saying, let me figure out this whole thing, what's next in the government's annual. So I think the pain will last for about 2 quarters, and that's right. But the key element I'd like people to remember is that demonetization was a political decision and not an economic decision.
Right.
The reason I emphasize that is that from a political perspective, it was to get good feedback from the people on the Prime Minister that he's taking the right steps. So now the focus is on getting back the people back on track. So that's why I would like to use the word saying demonetization is history. Remonetization is the new thing that we need to track. And we believe that it will take about 6 months for the amount of cash that the government wants put back. Now, as you remember, 86% of the currency was actually made illegal. Not all 86% is going to come back, because government doesn't want, again, a huge cash economy to be there. But maybe, let's say, 40 of the 86% comes back. Even that is going to take 6 months with all the printing presses going 24/7. So this remonetization process is the time when there will be weakness. When the cash comes back into the economy, I suspect that it will be back to business as usual in about 9 months at the extreme, 6 months at the earliest.
So you said that demonetization, at least to a certain extent, is a political move. Another event that we are looking for that may have political implications is the union budget. Now, before this weekend at least, we had some voices suggesting that there could be tax cuts. After that, of course, we had the Prime Minister speak of capital markets and taxation in general, and then the Finance Minister came in and made a clarification. This has nothing to do with long-term capital gains tax. But, keeping taxation in mind and other expectations, what you're looking at when it comes to the union budget, and what would be a good union budget for you?
We think that this union budget is probably the single most important union budget after the Modi election budget. The reason we say that is that the demonetization, it clearly is going to be a fiscal positive for the government. Because of all the money that's come in, the taxation thing that's come in. So how the government uses that money is the key. And so I think it's probably very important in terms of where he plays his card. Is he going to take that additional money and do additional infrastructure spending? Is he going to focus on job creation? Or is he going to do giveaways? Because there are 3 state elections during the year. So I think the budget is very, very critical. And so if you ask me what will be a good budget, is he takes that, gives part of it as taxation benefits so that he creates a mahal, a good environment, and then he puts it on infrastructure, especially in job-oriented sectors. So we think employment generation is the single most important thing the government needs to act on before the next general election. And not many people know of this. Everybody knows that India is a young country, India is among the youngest. But the hard facts are like this. Over the next decade, 2015 to 2025, the world is going to add 500 million people to the workforce. 124 million, that's 25% of those are going to be in India. So, and China is going to be negative 3 million. So if you look at it, our biggest competitor is not having enough young people. We have, but the imperative is to create job creation opportunities. So will this budget be used to make a very dramatic statement on that? That will be a killer budget if that really happens.
Okay, so we are also expecting the dollar to remain strengthened at least against the rupee for some time, and based on that, that really doesn't augur well when it comes to fund flows for India, foreign flows for India. My question then would be, what will bring foreign investors back? Will it be earnings or will it be valuations?
We don't think foreign investors come on valuations. They come only on the back of economy and earnings.
All right.
Why we are saying this is, see, there are basically broadly three classes of foreign investors who put money, right? There's first the long only pension funds, provident funds, superannuation funds of the international, where because those governments are committed to provide social security benefits and pension to their thing, they are seeking, as you know, interest rates in the US have been hovering at low 1 to 2%, negative in Japan, negative across Europe. So they can't hope to deliver on future promise without getting the equity bang from a emerging market scenario. These are actually, we look at then good economies which grow, they put their money even with a 5-10 year outlook. The other set of money which comes in is ETFs, exchange traded funds, which are Nifty ETFs and all of that trading. This is retail people's money which is put into these ETFs and then goes to an allocation based on MSCI index, emerging market index. So what decides that money flow is the weightage within the emerging market index, which is a function of the fiscal deficit, which is a function of the rating of the country and the growth prospect. So again, that money which retail investors put into this and then the allocation happens is again based on growth, which is read it as earnings. The third kind of money is a carry trade, which is essentially hedge funds borrowing money when they are cheaper and putting it in. That's the money which gets affected by valuations. The reason being that for them the currency, because when they borrow, if US interest rates go up, their borrowing rates go up, their margin, the 20% they put their capital, 80% they borrow from the bank. So that borrowing rate goes up, then the return, second, US with its rising interest rates becomes an investment opportunity for these funds, which are non-US based funds. So risk weighting for US is pretty much zero. Any other emerging market would come somewhere on those lines, right? So there again, India's risk weighting is based on the rating, right? Where I would say that compared to other emerging markets, India still is probably the only emerging market with a sustained domestic demand which can drive it. Most emerging markets, right, are dependent on the advanced countries to grow. They don't have enough of a self-sustaining. China and India, because of their local populations, are the ones which have their own. So I would say that FII money would still seek India. And your point about currency, while Indian currency is expected to weaken in a strengthening dollar, it's not just that weakening, it is relative to other economies, is the Indian country going to weaken more or less? Because every FII knows that when he goes from an advanced economy with a low interest rate to an emerging economy with a high interest rate, he is going to face devaluation. The point is, where is the devaluation going to be even more? Where the political risk is higher, where the interest rates are higher. As you know, we are in a stable inflation, stable interest rate kind of a scenario. Indian currency should not do as badly compared to other emerging markets. So overall, the FII pool is going to come down to the emerging market, but India should get more than its fair share in this.
So your equity multipliers fund has a lot of frontline bank stocks. So you have HDFC Bank, SBI, ICICI Bank. What data points have you been keeping an eye on with respect to demonetization that are most important when it comes to these frontline banking names?
See, for us, demonetization, as I mentioned, is a political event. It's a black swan event. Demonetization has not affected our outlook on any stock in this country, except that the correction which is happening in stocks is a buying opportunity for us. Why I'm saying this is, for us, demonetization is a max 12-month from last November to next November, 6 to 9 months from now impact, which has nothing to do with India's economy or its potential. It has derailed the economy in the short run, but that's only a postponement of consumption and not a destruction of consumption. So to us, the actual demonetization has not made us put any stock on a sell. On the contrary, certain sound fundamental stocks which are getting corrected because of the negative milieu surrounding demonetization has actually made us go and buy some of these stocks. So I would like to use demonetization as creating volatility in the market, and for a mutual fund, volatility is the biggest friend for us.
I suspect you would say the same, because before demonetization, the NBFC space was, it was moving from strength to strength. After that, we have seen some amount of correction. I believe, and does your reading stand the same with respect to some names that you own in your funds like Bajaj Finserv, Ujjivan or Max Financial for that matter?
Absolutely, because if you look at the fact of what is India's future growth based on, if you just go back to 2 months before demonetization.
Right.
As you mentioned, we were all worried about an overvalued market at that stage.
Right.
Correct?
Right.
Why was the Indian economy looking like on a very good growth wicket so that valuation was shot up? The three fundamental factors, right? One, the government consistently from 2014 has been spending on rural infrastructure, roads, railway construction, bridges. These have created non-farm sector employments, and per capita incomes in the rural area have been rising. So that's something that the government spent, including through Narega, where if you see the component of money of Narega spent on wages went from 65 to 72%.
Right.
So this is one thing which boosted the incomes. The second factor was the monsoon. Right, the monsoon, which being a good monsoon, naturally threw up a lot of harvest money to the rural population. The third factor is the pay commission, where 53% of government employees work in semi-urban and rural areas.
Right.
Now these three factors, tell me, has demonetization affected any one of these three? Right. On the contrary, the government is going to have even more money to spend on infrastructure because of an improved fiscal. Right. The monsoon's effect, that cash, instead of lying as cash in gunny bags, has actually moved into a banking system. And the pay commission was anyway a white economy, fully payment, all government salaries are actually paid into bank accounts. So what's happened is the temporary lull, which means that there's going to be a pent-up demand on consumption and boost up. So if you look at those stocks which went up in the run-up to demonetization, before they knew this was going to happen, were those which were expected to benefit. Now, if there's been a correction in those stocks, right, because they see a short-term impact that, a microfinance company which collects the repayments in cash is going to get affected. And what is the microfinance companies doing? They're forcing each of those to open accounts and do all of that process. So there'll be a short-term impact. But in the long run, why would their business model? It will now get cash-based, into account-based repayment pattern. So while you take some time to readjust in the economy, the long-run growth prospects for all of these continue to remain unshaken as far as we are concerned. So if I am getting the same stock which I was merrily buying in October, right, at 20%, 30% less, I'm all the more happy because thankfully for me, my investors have a 3, 4, 5 year outlook. So these short-term corrections, and where we are benefited as an industry, mutual fund industry, is that close to 3,500 to 4,000 crores of flows have been coming to the industry through SIPs. Now these continue sustained through all of these correction phases. So the mutual industry itself is sitting on a reasonable amount of cash to actually buy, and everybody knows the stocks they are tracking, they are waiting for that period. So I think that from that perspective for us, like I said, demonetization has been a good reality check that we don't have to answer people about the market's overvalued, and we actually know the stocks we are going to buy, and we keep looking at what is the right time to pick up those stocks because we are getting cash from the customers.
So and finally, sir, there must be sectors out there that you may be wary of for now getting into, that you may want to wait for more information to come in before you may start thinking about nibbling into those sectors. What sectors would they be?
See, if you ask me from a concern perspective on the sectors, see, I'll tell you, within the banking space, you mentioned banking, right? Now, how is demonetization impacting various banks? If you look at it, banks are surplus with a lot of cash. At the same time, this forced disclosure of cash has made a lot of people pay down loans, because that's a very legitimate way of converting your cash into accounts, right? So instead of putting money into savings account, what we hear is that a lot of borrowers, especially in the rural sector, have been going and prepaying their loans and putting that money into the banking system. So the credit deposit ratio of these banks are going to come down. At the same time, lending is not yet picking up because the industrial cycle is yet to pick up, and the personal finance will also get the short term because of consumption hitting. So banks are going to be sitting on a huge amount of idle money lying in CASA accounts. There's a limit to how much they can put into the government securities and keep, and the further opportunities for government security to go down and create capital gains is less. So actually all this new money, the net interest margins on this will not be as great as it should have been, right? To that extent, that's one factor. The second factor is that industrials, the capacity utilization in the country is over 72%. And that's why only the government was spending on capex, and that was leading to the non-farm sector employment, and whatever growth in core sector like cement, refinery, steel and all of that you saw was entirely government spend. Now with consumption taking a hit for the next 2 quarters, this capacity utilization going up is going to get delayed by a further 2 or 3 quarters, because unless consumption goes up beyond say 15-20% rise, then the 72 can go to 80, then corporates will think about starting to invest. So we think the capex cycle right, is going to get delayed a little bit more. So I would say that what we were probably looking at, saying that within 6 to 9 months we could see a pickup there, will probably get shifted to 12 to 18 months. So we would again, look at it carefully and buy those which are likely to see an earlier rise. So you ask me, that capex cycle is likely to get delayed a little bit further, unless the government makes a very strong statement in the budget about a huge increase in infrastructure spending.
Right. Well, Mr. Subramaniam, thank you for taking us through the many challenges that we are going to see, but one thing is certain, at least Mr. Subramaniam is very positive in the long run with respect to our Indian markets. Thank you, sir, for joining us.
Thank you.
And as for you guys, well, let's just take a look at what's happened in the markets today. We have seen some amount of weakness. We have seen the Nifty test at least 7,900 for a bit, and once again, we've seen a little bit of bounce back. Let's take a look at some of the key losers and gainers in today's day of trade. We have gainers in HUL, TCS, Bharti Airtel, and marginal gains for ITC, but only 4 gainers as against, well, 46 losers or 47 losers on the Nifty. With respect to losses, we have Hindalco, which has lost around nearly 5%, followed by Cipla, Bank of Baroda, Aurobindo Pharma, as well as Eicher Motors. On the whole, well, of course, the benchmarks are not looking so good. Let's also take a look at the, the options market, and this is where we're looking at substantial changes, considering we are looking at expiry right now. So, with respect to the range, we have, well, 8,000 on as far as the lower side or the upper side of the range is concerned, and 78 and 7,900 is looking at a lot of build up, and this of course is to do with the January series, not necessarily in December. And as you can see here, this is where we're looking at substantial unwinding of the 88,000 put. Other than that, we're also looking at more writing towards the 7,900. So, well, the range is changing, but the good part is that the activity in rollovers has picked up. Of course, it's only the first day of the expiry week, so there will be plenty more action, and we can also expect the wicks to move up further. But that is all that we have so far, and well, for more, you guys can also tune into bloombergquint.com. But till then, it's goodbye.